What if you could profit big in a recession without calling it top or perfectly timing the crash? That's exactly what you'll learn in this video. That's the power of learning option strategies. I'm Mike Bellafiore, co-founder of SMB Capital, a proprietary trading firm home to multiple 7 and even 8-figure per year traders. You've found the right place to level up your trading. Let's get to work.
Hi, I'm Seth Freudberg, and I'm the head options trader here at SMB Capital in Manhattan. And if you're like just about any trader or an investor, I'll bet you can recall many times that you've watched as a stock you love skyrockets in price before you get a chance to buy it. And before you know it, it's priced too high to safely enter a long trade. And in fact, at those times, you're often convinced that the more likely scenario is a pullback from its current level. And so you're stuck. You want to own the stock, but it's just too pricey to take the chance. But what if there was a way to actually profit from the inevitable pullbacks of a stock that may be overbought and be able to acquire the shares at a much cheaper price to take advantage of the inevitable bounce? Yet, and I know this sounds crazy, yet still make a small amount of money if the stock never pulls back at all. Well, there actually is a way to do that with a very simple option strategy known as the put broken wing butterfly. And that's what we're going to be teaching you in this video. So if that sounds like something you're interested in learning about, then stick around because you're going to want this strategy in your toolbox. Before we get into the option strategy that we'll be teaching you in today's video, if you're absolutely brand new to options trading and you don't know much about how options work, we've put together a video for you to understand options basics. And if you click the video appearing on your screen right now, it will lay the groundwork for you to understand the option strategy that we'll be sharing with you in this video. Then, when you're finished, you can come back and watch the rest of this video. We're in a very volatile, news-driven market, which is driven by fears of a trade war, budget deficits, elevated interest rates, and ominous rumblings in the bond market, all of which result in the possibility that at any time, the market could pull back dramatically. But at the same time, we've repeatedly witnessed how the market can shake off those fears with surprising speed and bounce back. And so it's a tricky time to get long the market when at any time a news event or economic development could derail the bounce which has taken place since early April. And you'll feel pretty foolish when you look back only to realize that you went long precisely when the market was ready to pull back and you ended up buying at exactly the worst time. But there is a way out of this dilemma. And so we're going to take a look at one of the best option strategies we know to deal with this exact circumstance. So let's head back to the very beginning of this year, 2025. Take a look at the Qs, which of course are a basket of stocks representing the tech-heavy NASDAQ 100 index. And as you can see, the Qs staged an impressive 25% rally in 2024, closing on the first trading day of 2025 at 510.23. And so it might have felt at that point that getting long the Qs might be too late. And in fact, the more likely next market move may well be a profit-taking pullback, which of course would cause you to draw down if you went long at this point. And so when professional options traders see a situation like this, there's a strategy that they can use to address a potential pullback and an inevitable bounce that takes place whenever an index experiences a pullback period. And we want to show you exactly how to put this trade together. And so the first step is to pick a location on the chart of the Qs where you'd be happy to go long the stock because you feel it's likely to find support after a pullback and bounce from there. And so suppose that you had identified 485 as a price at which you'd be willing to be long the Qs because you noticed that it had bounced from that price at the end of October and that the stock had actually found support at that level multiple times in September and October. And so let's say that on that first trading day of this year, January 2nd, 2025, at the end of the day, we pulled up an options chain for the end of the first quarter of this year, March 31st. And we headed down to the put side of that options chain and zeroing in on that 485 put strike price where we think there may be support, we went ahead and sold 2 of those 485 puts for a price of $9.97. And then we headed up to the 510 put which is what options traders refer to as the at the money put, because its strike price is very close to where the stock is trading at 510.23, and you bought one of those for 17.49. And then to control your broker's capital requirements for the trade, you went ahead and bought a put located at 365 for only 95 cents. And so when you do this, buying a put and then lower on the same options chain, selling two puts, and then much lower than that on the same options chain, buying a long put, that formation is what is known as a put broken wing butterfly to options traders. And it's a great trade to use in this circumstances you're about to find out. And so starting with the two puts we sold, you can see that the price was $9.97. But remember, each stock option represents rights involving 100 shares of a stock. So you multiply that by 100 and you sold two of them. And so when you multiply it all together, you end up with positive cash flow of $1,994. But then you turn right around and you have to spend $17.49 on that at the money put that you bought up at 510, and you also have to pay for that 365 put which you bought to control your capital in the trade, which cost you $95. And so the surprising thing here is that you actually enter into a trade intended to take advantage of a pullback, but in fact you receive cash for entering into the trade, and you'll see the significance of that a little bit later. And also, please take note of the fact that your broker will require you to have $9,350 in your account to make this trade, although your capital requirement would have been a little bit higher had you not bought that 365 put, as we had mentioned. Okay, so now that we've collected the $150, and you'll see your account cash balance increase by $150 as soon as you enter into this trade, let's move through to the day the trade expires. And you can see that the Qs, after peaking out in mid-February, began to sell off as fears of the tariff implications on the world economy began to impact the market. And by March 31st, the Qs had dropped below 500 and were trading at 468.92. And so at the end of that day, the day that this trade expired, we could see that the 510 put price had more than doubled since we bought it back in early January. And the two 485 puts that we sold had nearly doubled as well. And of course, the 365 put is way below the market, so that one will simply expire worthless. And so let's take a look at what happens if right at the close, we go ahead and sell that 510 put for $41.19, and we simultaneously buy back one of the two short puts at that 485 strike price, paying $16.97 to buy that one back. Well, in that case, then what is left is the 485 put, which is at a strike price a little more than 16 points above where the Qs are trading at this point. So you would be assigned 100 shares of the Qs at a price of 485, while that 365 put would just expire worthless. And so taking stock of where we are at this point, our final options profit, remember everything's expired now, is calculated by starting with that $150 in cash we first received when we entered the trade, then adding to it the cash we received selling the 510 put that had more than doubled in value, bringing in $4,119, while to close one of those 485 puts, that cost us $16.97, while the 365 put expired with a value of $0, resulting in options profit of $2,572, which you can think of as the final profit you're making because of the sell-off. So you're monetizing the sell-off with this strategy, but that's not the end of the story at all, because remember, we now own those 100 shares of the Qs at 485. So let's move forward to May 27th this week. And as you can see, after an initial further sell-off down as low as 402 actually at one point, the Qs rallied. And by May 27th had rallied all the way up to 521.22, recovering much of what it had lost in the sell-off. And so if we were to have sold our QQQ shares at the end of the day on May 27th, then let's analyze how the trade would have turned out. As you can see, selling those 100 shares for $521.22 would have brought in $52,122, obviously. Then, deducting the cost of having been assigned those shares at a total price of $48.5 and adding in the options profit that we received on March 31st, the total profit for the trade comes to $6,194. Now, what's so interesting about this is to consider what would have happened had you simply bought the shares on January 2nd instead of executing the broken wing butterfly. Had you done that, then those shares would, of course, be worth that same $52,122 today, but then you would have had to subtract out your original share cost, which was $510.23, the stock's price on January 2nd, and so you'd only have made $1,099 on the trade had you entered the trade that day. But when you compare that to the profit on the broken wing butterfly campaign, it's not even close. You would have made $6,194 from that approach, and that's as a result of really two factors. First is the profit that you made from the options, that $2,572 we made by selling the 510 put, offset by the cost of buying back one of the two 485 short puts. And secondly was the fact that we ended up buying the shares so much lower at 485 instead of 510.23 that these shares would have cost us on January 2nd. That fact, that lower cost basis, because we sold the puts at 485, creating a much lower cost basis, hugely boosted our profits. And one more thing, remember, if we had been wrong and the stock never sold off, but instead simply rallied straight to 521.22, then we'd still make $150 on the broken wing butterfly. Why? Because all three options would have expired worthless at expiration, because all of them would have had a strike price of 510 or lower, and therefore your consolation prize, in a sense, is $150. So in other words, even if your trade thesis was flat out wrong, you'd still make a profit on the trade. Although obviously the big money is made when your thesis is right and the market sells off first, after which you get assigned and then the market bounces. And so what I'd like you to take away from today's video is that if you ever find yourself in a situation where you want to get long a stock, but you just hate the current trading price, the broken wing butterfly technique is fantastic for both profiting from a pullback that inevitably strikes any stock that rallies aggressively, and at the same time allowing you to enter the stock at a much more reasonable price if the pullback that you had expected actually transpires. If it never transpires, no big deal. You still make that initial cash flow as your profit. But if you're right, you're usually going to be way better off making money from the sell-off and then enjoying an assignment of the shares at a much better price before the bounce happens. Professional options traders are trained in the use of the broken wing butterfly as a tool in their options trading toolbox, and they don't hesitate to pull that tool out of the box when the right opportunity emerges.
Now, if you'd like to learn 3 more option strategies that our pro traders use, including the unique options trick that allows you to make money while you wait to buy stocks or ETFs at the price you want, and the options income strategy that allows you to make consistent money whether the market goes up or down or sideways, and how to make money on a stock or index trade even if you're wrong on the direction, then click the link that's appearing right now at the top right-hand corner of your screen. That will open up the free workshop registration page in a new window. So don't worry, you won't lose this video. Or you can register directly for free at optionsclass.com.